Let me tell you something that most investors never figure out. When recessions hit, when markets crash, when unemployment spikes and consumer confidence collapses, there is one sector that keeps generating profits no matter what. One sector where the cash registers keep ringing, whether the economy is booming or falling apart. One sector that has survived the Great Depression, the stagflation of the 1970s, the dot-com crash, the 2008 financial crisis, and the COVID pandemic without missing a beat. I am talking about grocery stores. And today I am going to share with you the only 5 grocery stocks that have proven they can survive and thrive through any crisis. These are not speculative plays. These are not hot stocks that might work out. These are battle-tested companies with decades of performance through the worst economic conditions imaginable. Companies that kept paying dividends while other businesses were filing for bankruptcy. Companies that actually grew stronger during recessions because they understood something fundamental about human nature. People have to eat. No matter what happens to the economy, no matter how scared consumers become, no matter how much they cut back on discretionary spending, they still need to buy groceries. They might skip the vacation. They might delay buying a new car. They might cancel their streaming subscriptions. But they are not going to stop buying food for their families. This simple insight has guided some of my most successful investments over the decades, and it should guide yours too. Before I reveal the 5 grocery stocks, let me explain why this sector is so special and why most investors completely overlook it. The grocery business is not glamorous. Nobody gets excited talking about supermarkets at cocktail parties. There are no revolutionary new products, no exponential growth curves, no charismatic founders promising to change the world. Just stores that sell food to people who need to eat. But that apparent boring nature is exactly what makes grocery stocks so valuable for long-term investors. Boring is beautiful when it comes to investing. Boring means predictable cash flows. Boring means stable demand. Boring means competitors cannot easily disrupt your business with some new technology or business model. The grocery industry has looked essentially the same for over a century. Yes, there have been innovations, self-checkout, online ordering, curbside pickup, but the fundamental business, buying food at wholesale and selling it at retail to consumers, has not changed, and it is not going to change. People will still need physical stores to buy fresh produce and meat and dairy products for the foreseeable future. That stability translates into investment returns that compound reliably over decades. Now, let me take you back to 2008 to illustrate why grocery stocks are so resilient. The financial system was collapsing. Lehman Brothers had just filed for bankruptcy. The stock market was in free fall. Unemployment was spiking. Consumer confidence hit record lows. People were genuinely afraid that the entire economic system might collapse. What do you think happened to grocery store sales during this period? They went up, not down, up. While retailers selling discretionary goods saw sales collapse by 20, 30, even 50%. Grocery stores saw modest but consistent growth. Why? Because people still needed to eat. In fact, as the economy deteriorated, grocery sales actually benefited from what we call the trade-down effect. People who used to eat at restaurants started cooking at home to save money. People who used to buy premium brands switched to store brands, but they still bought groceries. The money that used to go to restaurants and entertainment and travel got redirected to the supermarket. This is the magic of the grocery business during recessions. Not only does demand remain stable, but it often increases as consumers cut back on more expensive alternatives. I witnessed the same pattern during the COVID pandemic. When lockdowns began and restaurants closed, grocery stores saw unprecedented demand. Sales surged 20, 30, even 40% above normal levels. Store shelves were emptied as people stocked up on essentials. Grocery store employees became essential workers, keeping the country fed during a national emergency. The stocks of well-run grocery companies soared while most of the market was crashing. This pattern repeats in every crisis. Grocery stores are not just resilient, they are anti-fragile. They actually benefit from the chaos that destroys other businesses. That is an incredibly valuable characteristic for any investment to have. Now let me explain my criteria for selecting these 5 grocery stocks. I am not just looking for any company that sells food. I am looking for specific characteristics that indicate a company can survive and thrive through any economic environment. First, I look for a long operating history. I want companies that have been in business for decades, preferably through multiple recessions. A company that survived the 1970s stagflation and the 2008 financial crisis has proven its business model works in terrible conditions. Second, I look for consistent profitability. I want companies that make money every single year, not companies that swing between profits and losses depending on economic conditions. Consistency indicates a durable competitive advantage. Third, I look for strong balance sheets. Companies with too much debt are vulnerable during recessions when credit tightens and financing costs spike. I want companies with conservative leverage that can weather any storm without financial distress. Fourth, I look for sustainable dividends. A company that has paid dividends for decades and increased them regularly demonstrates discipline and shareholder focus. Dividend cuts during recessions indicate management that does not understand capital allocation. Fifth, I look for competitive advantages that protect the business from both economic downturns and competitive threats. This could be scale, geographic dominance, private label brands, or customer loyalty programs. Without competitive advantages, even a grocery store can be destroyed by better capitalized competitors. With those criteria in mind, let me tell you about the first grocery stock that survives every crisis, Walmart. Now I know what you are thinking. Walmart is not just a grocery store. It is the largest retailer in the world, selling everything from electronics to clothing to home goods. But here is what most people do not realize. Grocery sales now account for over 56% of Walmart's revenue. More than half of the money Walmart makes comes from selling food. That makes Walmart the largest grocery retailer in America by a significant margin. And the grocery business is the foundation that makes the rest of Walmart's business model work. Think about the genius of Walmart's strategy. People need to buy groceries every week. When they come to Walmart for milk and bread and produce, they also pick up other items they need. Maybe some cleaning supplies, maybe some clothes for the kids, maybe a new television. The grocery business drives traffic that supports all of Walmart's other categories. Without grocery, Walmart would be just another big box retailer competing with Amazon on electronics and general merchandise. With grocery, Walmart has a recurring traffic driver that keeps customers coming back week after week. Now let me tell you why Walmart survives every crisis. It starts with scale. Walmart is so large that it has purchasing power no competitor can match. When Walmart negotiates with suppliers, it gets better prices than anyone else because it buys more than anyone else. Those cost advantages get passed on to consumers as lower prices, and lower prices are exactly what consumers want during recessions.
During the 2008 financial crisis, Walmart's comparable store sales actually increased while most retailers saw declining traffic.
Consumers traded down from more expensive grocery stores to Walmart to stretch their budgets. The company gained market share during the worst economic conditions in decades. The same thing happened during other recessions.
Walmart is the ultimate beneficiary of consumer belt-tightening because it is already the low-price leader. Where else are budget-conscious consumers going to go?
Walmart also has geographic reach that provides diversification and stability. The company operates over 10,000 stores in 24 countries. It has stores in rural America and urban centers. It has stores in wealthy communities and lower-income neighborhoods.
This geographic diversity means that localized economic problems do not significantly impact overall results. If one region is struggling,
another region might be doing fine. The portfolio effect smooths out results over time. Walmart's balance sheet is fortress-like. The company has investment-grade credit ratings and manageable debt levels relative to its cash flows. It could weather a severe recession without any financial distress. This is crucial because financial distress during recessions is what destroys companies. When you cannot roll over debt or access credit markets, you might be forced into bankruptcy even if your underlying business is sound. Walmart will never face that situation. And Walmart has paid dividends for 50 consecutive years, increasing the dividend every single year. That is half a century of returning cash to shareholders through every conceivable economic environment. The Great Recession, the COVID pandemic, oil shocks, interest rate spikes. Through all of it, Walmart kept paying and raising its dividend. That track record indicates a company and a management team that understands shareholder value creation. The second grocery stock that survives every crisis is Costco. Costco operates a unique business model that has proven remarkably resilient through economic cycles. Instead of making money primarily on product sales, Costco makes most of its profit from membership fees. Customers pay an annual fee, currently $65 for the basic membership and $130 for the executive membership, for the privilege of shopping at Costco. In exchange, Costco sells products at essentially cost, marking them up only enough to cover operating expenses. This model creates incredible customer loyalty. Once someone has paid for a Costco membership, they are highly motivated to shop there to get value from their membership fee. Renewal rates for Costco memberships exceed 90%. That is extraordinary customer retention. And those membership fees provide a predictable, recurring revenue stream that keeps flowing regardless of economic conditions.
During recessions, Costco actually tends to perform even better than normal. The value proposition becomes even more compelling when budgets are tight.
Customers who might have shopped at more expensive stores trade down to Costco to save money. Existing members shop more frequently to maximize the value of their membership. The company gains market share as price-conscious consumers seek out the best deals.
During the 2008 financial crisis, Costco's membership count continued to grow.
Revenue dipped slightly but recovered quickly. Earnings remained solid throughout. The stock outperformed the broader market during the downturn and then surged during the recovery. This pattern repeats in every economic cycle. Costco is simply one of the most recession-resistant businesses in the world. The quality of Costco's customer base also contributes to its resilience. Costco members tend to be more affluent than average. The company's focus on bulk purchasing means customers need the storage space and transportation capacity to handle large quantities. This tends to select for homeowners with cars and garages, a demographic that is generally more financially stable. During recessions, lower-income consumers cut spending dramatically. Middle and upper-income consumers cut spending much less. By serving a relatively affluent customer base, Costco is somewhat insulated from the worst effects of economic downturns on consumer spending. Costco's balance sheet is conservative, with minimal debt relative to its cash flows. The company generates substantial free cash flow that funds store expansion, dividends, and share repurchases without requiring external financing. This financial strength means Costco can continue investing in growth even during recessions when competitors might be retrenching. Over time, this allows Costco to gain market share as weaker competitors struggle or fail. The dividend track record is impressive, although not as long as some others on this list. Costco has paid dividends since 2004 and increased them consistently. The company also pays special dividends periodically when cash balances become larger than needed for operations. These special dividends can be substantial, sometimes $10 or more per share. The combination of regular and special dividends has provided shareholders with attractive income while also benefiting from the stock's appreciation over time. The third grocery stock that survives every crisis is Kroger. Kroger is the largest traditional supermarket chain in America, operating nearly 2,800 stores under various banners, including Kroger, Ralph's, Fred Meyer, Harris Teeter, and many others. Unlike Walmart, which is a general merchandise retailer with a large grocery component, or Costco, which is a membership warehouse club, Kroger is a pure-play grocery retailer. This focus has allowed Kroger to develop expertise and scale advantages, specifically in the grocery business. Kroger's history demonstrates its resilience. The company was founded in 1883, making it 142 years old. Think about what that means. Kroger has survived the Panic of 1893, the Great Depression, 2 World Wars, the stagflation of the 1970s, the 2008 financial crisis, the COVID pandemic. Through all of these crises and countless smaller recessions and disruptions, Kroger has continued operating and serving customers. That kind of longevity is not an accident. It reflects a business model and corporate culture capable of adapting to changing conditions while maintaining fundamental stability. Kroger's competitive advantages center on scale, private label brands, and data-driven personalization. With nearly 3,000 stores and annual revenues approaching $150 billion, Kroger has purchasing power that smaller competitors cannot match.
The company leverages this scale to negotiate better prices from suppliers and to invest in technology and infrastructure that smaller chains cannot afford. Private label products are a particular strength.
Kroger's store brands, which include the Our Brands portfolio of over 15,000 products, generate higher margins than national brands while also giving customers a lower-priced alternative. During recessions, customers trade down from national brands to private label, which actually improves Kroger's profit margins even as overall spending tightens. The company has invested heavily in developing high-quality private label products that customers actually prefer, not just tolerate as a cheaper alternative. Data and personalization have become increasingly important to Kroger's competitive position. The company's loyalty program has over 60 million households enrolled, providing detailed data on shopping behavior and preferences. Kroger uses this data to personalize promotions and recommendations, increasing customer loyalty and basket sizes. This data asset becomes more valuable over time as the company accumulates more information and develops better algorithms to use it. Competitors without similar data assets are at a significant disadvantage in trying to win customers away from Kroger. Kroger's balance sheet is solid with investment-grade credit ratings and manageable debt levels. The company generates consistent free cash flow that funds dividends, share repurchases, and store investments. During recessions, Kroger has demonstrated the ability to maintain operations and investments while weaker competitors struggle. This allows the company to gain market share during downturns as competitors close stores or reduce service levels. The dividend track record is excellent. Kroger has paid dividends for decades and increased them consistently. The current yield is attractive for income-focused investors while also leaving room for continued dividend growth. The combination of stable operations, consistent cash flows, and growing dividends makes Kroger an ideal holding for investors seeking reliable income through economic cycles. The fourth grocery stock that survives every crisis is Albertsons. Albertsons is the second largest traditional supermarket operator in America behind Kroger, with approximately 2,200 stores under banners including Albertsons, Safeway, Vons, Jewel-Osco, and many others. The company's geographic footprint complements Kroger's, providing investors with exposure to different regional markets. While Kroger is strong in the Midwest and Southeast, Albertsons has particular strength on the West Coast and in the Mountain West. This geographic diversity can provide portfolio benefits for investors holding both companies. Albertsons has a complicated corporate history involving multiple ownership changes, bankruptcies, and restructurings. This history might seem to contradict my claim that it survives every crisis. But the current Albertsons emerged from that history as a stronger, better managed company. The private equity owners who took Albertsons through bankruptcy used the process to shed unprofitable stores, restructure debt, and improve operations. The company that emerged and eventually went public again in 2020 is leaner and more competitive than the Albertsons of the past. Sometimes crisis and restructuring create better businesses by forcing difficult decisions that would never be made otherwise. The current Albertsons has several competitive advantages. First, strong regional market positions. In many of its markets, Albertsons banners are the dominant grocery retailer with loyal customer bases built over decades. Safeway in Northern California, Vons in Southern California, Jewel-Osco in Chicago. These are entrenched brands that customers have shopped at for generations. That kind of loyalty and market position is difficult for competitors to dislodge. Second, private label strength. Like Kroger, Albertsons has invested heavily in developing high-quality store brand products. The own brands portfolio generates higher margins and provides customers with value alternatives during recessions. Third, pharmacy operations. Many Albertsons stores include pharmacies, which provide a recurring traffic driver as customers pick up prescriptions and then shop for groceries. Pharmacy customers tend to be older and more affluent than average, a valuable demographic. Fourth, loyalty program and digital capabilities. Albertsons has invested in modernizing its technology and digital experience. The loyalty program provides customer data for personalization, while digital capabilities, including online ordering and delivery, meet evolving customer expectations. The balance sheet has improved significantly since the company emerged from restructuring. Debt levels remain elevated compared to some peers, but are manageable given cash flow generation. The company is focused on paying down debt over time, which will further strengthen the financial position and provide more flexibility for dividends and share repurchases. Albertsons pays a dividend, though the track record is short given the recent public offering. As the company continues to execute its strategy and strengthen its balance sheet, dividend growth should follow. For investors willing to accept slightly more risk, Albertsons offers exposure to a resilient business at an attractive valuation. The fifth grocery stock that survives every crisis is Target. Like Walmart, Target is not a pure-play grocery retailer. The company is a general merchandise retailer that has significantly expanded its grocery business over the past 2 decades. Food and beverage now represent approximately 20% of Target's sales, making it a meaningful part of the overall business. And like Walmart, Target's grocery business drives traffic that supports all other categories. Customers who come to Target for groceries often pick up other items while they are there. This traffic driving effect makes the grocery business strategically important even beyond its direct contribution to revenue and profit. Target occupies a unique position in the retail landscape. It is not as cheap as Walmart, but it is not as expensive as traditional department stores. Target has cultivated an image of affordable style, offering trendy products at accessible prices. This positioning appeals particularly to middle and upper middle class suburban families, a demographic with relatively stable income and spending patterns. During recessions,
Target does experience some pressure as customers trade down to lower-priced alternatives, but Target also benefits from customers trading down from even more expensive retailers.
The net effect is that Target's sales are relatively stable through economic cycles, though with more volatility than pure grocery retailers. Target's recent investments in digital capabilities and store experience have strengthened its competitive position. The company has developed industry-leading capabilities in same-day fulfillment, including curbside pickup, same-day delivery through shipped and ship from store.
These capabilities proved invaluable during the COVID pandemic when customers wanted to avoid spending time in stores. Target's digital sales grew over 100% during the pandemic and have remained elevated even as in-store shopping resumed.
The company's stores also serve as fulfillment nodes for online orders, giving Target a cost advantage over pure e-commerce competitors that must ship from distant warehouses. Target's balance sheet is strong with investment-grade credit ratings and conservative leverage. The company generates substantial free cash flow that funds store investments, dividends, and share repurchases.
During recessions, Target has demonstrated the ability to maintain operations and continue returning cash to shareholders.
The dividend track record is impressive. Target has paid dividends for over 50 years and increased them for over 50 consecutive years. That makes Target a dividend king, a distinction shared by only a handful of companies. The combination of stable operations, consistent cash flows, and decades of dividend growth makes Target an excellent choice for income-focused investors seeking crisis-resistant holdings. Now, let me explain how these 5 companies work together in a portfolio to provide maximum protection through economic cycles. Each company has slightly different characteristics and exposures.
Walmart is the low-price leader that benefits most directly from consumer trade-down during recessions. Costco serves a more affluent customer base with a unique membership model that provides recurring revenue. Kroger is a pure-play grocery retailer with strong private label brands and regional market positions. Albertsons provides geographic diversification and exposure to different regional markets. Target offers exposure to general merchandise with grocery as a traffic driver. Together, these 5 companies provide diversified exposure to the resilient grocery sector while minimizing company-specific risk.
If one company faces challenges, whether from management mistakes, regional economic problems, or competitive pressures, the others provide offsetting stability.
The portfolio effect reduces volatility while maintaining exposure to the fundamental resilience of the grocery business.
The income characteristics of this portfolio are attractive for investors seeking reliable cash flow. All 5 companies pay dividends with varying yields and growth rates.
Walmart and Target have the longest track records with over 50 years of consecutive dividend increases. Kroger and Costco have shorter but still impressive histories. Albertsons is earlier in its dividend journey but has the potential for significant growth as the balance sheet strengthens. Together,
these companies provide a diversified income stream that has proven reliable through every economic environment. Let me share some thoughts on valuation because paying the right price matters enormously, even for great businesses. These grocery stocks are not cheap in the traditional sense. They trade at premium multiples compared to the broad market because investors recognize their defensive characteristics and bid up prices accordingly. During recessions, these premium valuations often expand further as investors seek safety. This means you are unlikely to find these stocks at bargain prices except during brief periods of market dislocation. The best approach is to build positions gradually over time rather than trying to time a perfect entry point. Dollar cost averaging into positions means you will buy some shares at higher prices and some at lower prices, averaging out to a reasonable cost basis over time. The goal is to own these companies for decades, not to trade them for short-term profits. Over long holding periods, the exact entry price matters much less than the quality of the underlying business and the consistency of its cash flows. I also want to address the risks that even these resilient businesses face. No investment is without risk, and grocery stocks are no exception. Competition is intense. Walmart, Costco, Kroger, Albertsons, and Target all compete with each other as well as with regional chains, discount grocers like Aldi and Lidl, and online retailers like Amazon. Price wars can compress margins and reduce profitability for all participants. Technology disruption is possible. While I do not believe online grocery will replace physical stores anytime soon, the shift to digital channels does require significant investment and changes to business models. Companies that fail to adapt will lose share to those that successfully integrate digital capabilities. Labor costs and availability are ongoing challenges. Grocery stores are labor-intensive businesses, and rising wages compress margins. Labor shortages can impact service levels and customer experience. Regulatory and political risks exist. Grocery companies face regulations around food safety, labor practices, and environmental impact. Changes in minimum wage laws directly affect profitability. Antitrust scrutiny can block acquisitions that would otherwise create value. These risks are real, and investors should not ignore them. But in my experience, they are manageable for well-run companies with strong competitive positions. The fundamental resilience of the grocery business, driven by the unchanging human need to eat, provides a floor under performance that does not exist in most industries. Even in worst-case scenarios, people will still buy groceries. The question is which companies will serve them. Let me talk about position sizing, because how much you allocate to these grocery stocks matters. For most investors, I would suggest that grocery stocks could reasonably represent 10 to 20% of an equity portfolio. This is enough to provide meaningful defensive benefit during recessions while not over-concentrating in a single sector. Within the grocery allocation, you could equal weight all 5 companies or overweight those you have highest conviction in. I would suggest slightly higher weights to Walmart and Costco given their longer track records and stronger competitive positions, with smaller weights to Kroger, Albertsons, and Target. But reasonable investors could disagree on the exact allocation. The key is to own these companies before you need them. The time to build defensive positions is when the economy is strong and markets are calm, not when recession is imminent and everyone else is trying to buy the same safe havens. By the time a recession is obvious, defensive stocks have usually already been bid up to premium valuations. Smart investors position themselves in advance and then simply hold through the turbulence. I want to share a story that illustrates the value of owning recession-resistant stocks. During the 2008 financial crisis, I watched many investors panic and sell their entire portfolios as markets collapsed. They locked in catastrophic losses and then sat in cash as the market recovered. The psychological damage was so severe that many of them never returned to investing. They missed the decade-long bull market that followed. But investors who owned recession-resistant stocks, like grocery retailers, had a different experience. Yes, their portfolios declined during the crash. No stock is immune from market panic. But the declines were more modest than the overall market. And the dividends kept coming, providing income and psychological reassurance during the darkest days. These investors were able to stay invested because their portfolios were not collapsing as severely. They did not panic sell. They held through the crisis and participated fully in the recovery. The defensive characteristics of their holdings gave them the psychological stability to behave rationally when everyone else was panicking. That psychological benefit is hard to quantify, but enormously valuable. The same dynamic plays out in every crisis. Investors with recession-resistant portfolios are able to maintain discipline and stay invested. Investors with aggressive portfolios often panic and sell at the worst possible time. Over long periods, the ability to stay invested matters more than chasing maximum returns during good times. Steady compounding beats boom and bust cycles. Let me close with some thoughts on the role of grocery stocks in a broader investment strategy. I am not suggesting that anyone put their entire portfolio in grocery stocks. These are defensive holdings that provide stability and income, not maximum growth. A well-constructed portfolio includes a mix of different types of investments that serve different purposes. Growth stocks for capital appreciation, value stocks for income and stability, international stocks for diversification, bonds for downside protection, real estate for inflation hedging. Each component serves a purpose in the overall allocation. Grocery stocks fit into the stability and income component of a portfolio. They are not going to double in a year like a hot technology stock might, but they are also not going to collapse by 80% when the market crashes. They will keep paying dividends regardless of what happens in the economy. They will provide a foundation of reliability that allows you to take more risk elsewhere in your portfolio. Think of grocery stocks as the anchor that keeps your portfolio from drifting too far during storms. They provide ballast and stability. They let you take risk in other areas, knowing that part of your portfolio will hold up no matter what. This is the role I see for Walmart, Costco, Kroger, Albertsons, and Target. Anchors of stability in an uncertain world. The businesses I have described today are not glamorous. They do not promise to change the world or disrupt entire industries. They simply sell food to people who need to eat. But that simple, boring, essential function has generated reliable profits and dividends through every crisis for over a century, and it will continue to do so for decades to come. Let me go deeper into each of these companies because understanding the details of their competitive advantages is crucial to having conviction during market downturns. When stocks are crashing and headlines are screaming about economic catastrophe, you need deep understanding to resist the urge to sell. Shallow knowledge leads to panic selling. Deep knowledge enables patient holding. Starting with Walmart, let me explain more about why this company is so extraordinarily resilient. The company was founded by Sam Walton in 1962 in Rogers, Arkansas. Sam built the company on a simple philosophy of everyday low prices enabled by relentless cost-cutting and operational efficiency. That philosophy remains embedded in Walmart's culture today, over 60 years later. The headquarters in Bentonville is famously Spartan. Executives fly coach. Expense accounts are minimal. This frugal culture keeps costs low and enables Walmart to offer prices competitors cannot match. Walmart's logistics and distribution network is one of the most sophisticated in the world. The company operates over 150 distribution centers in the United States alone. These facilities are strategically located to minimize transportation costs and enable rapid replenishment of store shelves. When you walk into a Walmart store, the products you see on the shelves were carefully selected, sourced, transported, and placed there through a system that has been optimized over decades. Competitors who want to match Walmart's prices would need to build similar infrastructure, which would require billions of dollars and many years. This infrastructure is a competitive moat that protects Walmart's market position. The company's relationship with suppliers is another source of advantage. Walmart is the largest customer for many consumer packaged goods companies. This gives Walmart enormous leverage in negotiations. Suppliers want access to Walmart's customer base and are willing to offer favorable terms to maintain that relationship. Walmart passes these savings on to consumers in the form of lower prices, which drives traffic, which makes Walmart even more important to suppliers. This virtuous cycle reinforces Walmart's competitive position over time. During recessions, Walmart benefits from a phenomenon I call flight to value. Consumers who normally shop at more expensive retailers trade down to Walmart to stretch their budgets. They discover that Walmart's quality is perfectly acceptable and the prices are significantly lower. Many of these consumers never go back to their previous stores, even after the recession ends. Walmart gains permanent market share during every economic downturn. This is why the company has grown through every recession since its founding. The worse the economy gets, the better Walmart performs relative to competitors. Let me also discuss Walmart's international business, which provides diversification that many investors overlook. The company operates in 19 countries outside the United States. The international segment generates significant revenue and profits while also providing growth opportunities that the mature U.S. market cannot match. Countries like Mexico and India are experiencing rapid growth in organized retail as consumers transition from traditional markets to modern supermarkets. Walmart is well positioned to capture this growth over the coming decades. Moving to Costco, let me explain more about why the membership model is so powerful. When a customer pays $65 or $130 per year for a Costco membership, they are making a commitment. They have skin in the game. They are motivated to shop at Costco frequently to get value from their membership fee. This creates habitual shopping behavior that is extremely sticky. Once someone becomes a Costco member and integrates Costco shopping into their weekly routine, they rarely leave. The 90+% renewal rate demonstrates this stickiness. The membership fee also provides a financial cushion that allows Costco to price products more aggressively than competitors. Costco's target markup on products is only about 11 to 14%, far below typical retail markups of 25 to 50%. The company can afford these thin margins because the membership fees provide a separate profit stream that covers overhead and generates shareholder returns. This pricing strategy creates enormous value for members who save far more than their membership fee costs over the course of a year. Customers recognize this value, which is why they keep renewing. Costco's product selection strategy is also unique and contributes to its resilience. Unlike typical retailers who carry tens of thousands of different products, Costco carries only about 4,000. This limited selection might seem like a disadvantage, but it is actually a strength. By carrying fewer products, Costco can buy in much larger quantities of each item, which gives the company more negotiating leverage with suppliers. The limited selection also reduces complexity in stores, enabling more efficient operations and lower costs. And customers actually appreciate not having to choose among dozens of similar products. They trust that Costco has selected the best option at the best price. The treasure hunt shopping experience is another aspect of Costco that drives customer engagement. In addition to staple products that are always available, Costco regularly features special buys on seasonal items, closeouts, and unique products. Customers never know exactly what they will find on any given visit. This unpredictability creates excitement and encourages frequent visits. Customers do not want to miss out on a great deal, so they come back regularly to see what is new. This treasure hunt element differentiates Costco from the predictable sameness of most retailers. Costco's employee relations are worth discussing because they contribute to the company's long-term success. Costco pays employees significantly above minimum wage and provides benefits that are generous by retail industry standards. This might seem like a cost disadvantage, but it actually creates value. Higher wages attract better employees. Better employees provide better customer service. Better customer service drives customer loyalty and repeat business. Lower turnover reduces training costs and improves institutional knowledge. Costco's employee-focused culture is a competitive advantage that contributes to resilience through economic cycles. Let me expand on Kroger's competitive position because there are aspects that most investors do not fully appreciate. Kroger operates a remarkably sophisticated supply chain that enables the company to move products from suppliers to store shelves with minimal waste and maximum efficiency. The company operates 35 distribution centers and over 40 manufacturing plants that produce private label products. This vertical integration provides cost advantages and quality control that competitors who rely entirely on third-party suppliers cannot match. Kroger's approach to store formats demonstrates strategic flexibility that enhances resilience. The company operates traditional supermarkets, natural and organic stores through the Harris Teeter and Fresh Fare banners, convenience stores, and marketplace stores that combine groceries with general merchandise. This format diversity allows Kroger to serve different customer segments and adapt to changing consumer preferences. If consumer tastes shift toward natural and organic products, Kroger has formats that serve that demand. If consumers want one-stop shopping for groceries and household goods, Kroger has marketplace stores that provide that convenience. The company's fuel business is an underappreciated contributor to resilience. Kroger operates over 1,500 fuel centers, typically located in the parking lots of its grocery stores. Customers earn fuel points from grocery purchases that can be redeemed for discounts on gasoline. This integration creates a loyalty loop that keeps customers coming back. During periods of high gas prices, the fuel points become even more valuable, driving increased grocery shopping as customers seek to accumulate discounts. This integration of grocery and fuel creates stickiness that standalone grocery retailers cannot match. Kroger's data and analytics capabilities deserve more attention because they represent a growing competitive advantage. The company's loyalty program captures detailed information about customer shopping behavior. Kroger has used this data to develop sophisticated personalization algorithms that target promotions to individual customers based on their preferences and purchase history. A customer who regularly buys organic products might receive coupons for new organic items. A customer who tends to be price sensitive might receive discounts on staple items. This personalization increases the relevance of marketing communications and drives higher customer engagement. The company has also developed a growing media business that monetizes its customer data. Kroger Precision Marketing sells advertising to consumer packaged goods companies who want to reach Kroger's customers with targeted messages. This advertising revenue is high margin and growing rapidly. Over time, the media business could contribute meaningfully to Kroger's profitability while leveraging existing assets and capabilities. Let me discuss Albertsons in more depth because the company's turnaround deserves recognition. The Albertsons that exist today is fundamentally different from the struggling company that went through bankruptcy in the mid-2000s. Private equity ownership imposed discipline and forced difficult decisions that transformed the business. Underperforming stores were closed, redundant corporate functions were eliminated, supply chain and technology were modernized. The company that emerged was leaner, more efficient, and better positioned to compete. Albertsons' regional banner strategy is worth understanding because it differs from competitors who operate under a single national brand. Albertsons maintains distinct regional banners including Safeway, Vons, Pavilions, Jewel-Osco, Shaw's, Acme, and many others. Each banner has its own identity and customer relationships developed over decades. Customers feel loyalty to these regional brands rather than to the Albertsons corporate parent. This localized approach enables better adaptation to regional preferences and competitive conditions. What works in Southern California might not work in Chicago, and the banner strategy allows for regional customization. The company's real estate portfolio is an underappreciated asset. Many Albertsons stores occupy prime locations that were secured decades ago when real estate was less expensive. These stores are embedded in communities and have established customer relationships. Competitors who want to enter these markets would need to find and develop new locations, which is difficult and expensive in many established suburban areas. The real estate provides a form of competitive moat that protects market share. Albertsons has invested significantly in its own brand's private label portfolio. The company now offers over 13,000 private label products across various quality tiers. The O Organics brand serves customers seeking organic products. The Open Nature brand focuses on natural products. The Signature Select brand offers quality products at mainstream prices. These private label options provide margin enhancement during normal times and value alternatives during recessions when customers trade down from national brands. Let me expand the discussion of Target because the company has undergone a remarkable transformation over the past decade. Under the leadership of Brian Cornell, who became CEO in 2014, Target has invested billions of dollars in store remodels, digital capabilities, and supply chain modernization. These investments have transformed Target from a struggling retailer into one of the best-positioned companies in the industry. Target's same-day fulfillment capabilities are industry-leading. The company offers order pickup, where customers order online and retrieve items at the store. Drive Up, where employees bring orders to customers' cars in the parking lot. And same-day delivery through Shipt, which Target acquired in 2017. These services provide convenience that pure e-commerce retailers struggle to match. Amazon might deliver in 1 or 2 days, but Target can have your order ready in hours. The stores themselves serve as fulfillment nodes for digital orders. When a customer orders something online from Target, it is often shipped from a nearby store rather than a distant warehouse. This enables faster delivery at lower cost. Target estimates that fulfilling orders from stores costs 90% less than fulfilling from traditional distribution centers. This structural cost advantage enables Target to compete effectively with online retailers while also maintaining physical stores that serve walk-in customers. Target's own brand portfolio is exceptionally strong. Brands like Good & Gather in food, All in Motion in athletic apparel, Threshold in home goods, and Cat & Jack in children's clothing generate billions of dollars in sales at margins higher than national brands. These own brands differentiate Target from competitors and provide value that customers cannot find elsewhere.
The quality and design of Target's own brands has improved dramatically in recent years, making them genuine alternatives to premium national brands rather than just cheap substitutes. The company's partnership strategy deserves recognition. Target hosts shop-in-shop partnerships with Ulta Beauty, Apple, and Disney, among others. These partnerships bring complementary products and customer traffic into Target stores while enabling partners to access Target's customer base without operating their own locations. The Disney shops are particularly clever, creating a destination for families during key shopping seasons like back to school and holiday. Now let me discuss how to think about these investments over very long time horizons, because that is the perspective that matters most. When I invest in a company, I am not thinking about what the stock will do next quarter or next year. I am thinking about what the business will look like in 10 or 20 or 30 years. Will customers still need this product or service? Will the company still have competitive advantages? Will the management culture still prioritize shareholders? For grocery retailers, I am confident that the answers are yes. People will still need to eat in 30 years. The infrastructure and scale advantages that these companies have built over decades will still matter. The management cultures that have enabled success through multiple economic cycles will continue to guide decision-making. This long-term perspective enables patient holding through short-term volatility. When grocery stocks decline during market sell-offs, I do not panic because I know the underlying businesses have not changed. People are still buying groceries. Cash registers are still ringing. Dividends are still being paid. The short-term stock price movement is noise that obscures the long-term signal of value creation. Investors who understand this can hold confidently while others panic and sell. The dividend income from these grocery stocks also enables patient holding. When you receive quarterly dividend checks from your holdings, you have tangible evidence that your investments are generating real returns regardless of stock price movements. This income provides psychological reassurance during difficult times. Even if the stock price is down, the dividend payment reminds you that you own pieces of real businesses that generate real profits and share them with shareholders. I want to address the concern that some investors have about disruption in the grocery industry. Amazon's acquisition of Whole Foods in 2017 sparked fears that the technology giant would revolutionize grocery and destroy traditional retailers. But those fears have proven overblown. Grocery is a fundamentally different business than the electronics and general merchandise categories where Amazon dominates. Fresh food requires different logistics and expertise. Customer expectations around in-store experience are higher. Margins are thinner, making it harder to subsidize growth with losses from other businesses. The traditional grocery retailers have proven more adaptable than skeptics expected. They have developed their own e-commerce capabilities. They have expanded delivery and pickup services. They have invested in store experience and private label products that differentiate them from online competitors. Rather than being disrupted, they have evolved, and their physical store infrastructure, which once seemed like a liability in the age of e-commerce, has proven to be an asset that enables same-day fulfillment competitors cannot match. Let me share more detailed thoughts on how to actually implement this strategy in your own portfolio. The first question many investors have is whether to buy individual grocery stocks or to use an exchange-traded fund that provides exposure to the sector. I prefer individual stocks because they allow you to concentrate on the highest quality companies rather than owning everything in the sector, including weaker competitors. An ETF that tracks the consumer staples sector would include grocery retailers, but also tobacco companies, packaged food companies, and personal care companies that have different characteristics and risks. By selecting individual stocks, you can build a portfolio of only the most resilient grocery retailers with the strongest competitive positions. The timing of purchases matters less than most people think, but it is still worth discussing. I do not try to time the market because I know it is impossible to consistently predict short-term price movements. Instead, I use dollar cost averaging to build positions gradually over time. This approach means buying shares at regular intervals regardless of price. Sometimes you buy at higher prices, sometimes you buy at lower prices. Over time, the purchases average out to a reasonable cost basis. More importantly, dollar cost averaging removes the psychological pressure of trying to pick the perfect entry point. You just buy regularly and let the strategy work.
If you do want to be opportunistic about entry points, grocery stocks tend to become particularly attractive during periods of market panic when investors sell indiscriminately. During the 2008 financial crisis, grocery stocks declined, along with the broader market, even though their underlying businesses remained stable. This created buying opportunities for investors who recognized that the sell-off was irrational. The same dynamic occurred during the COVID crash in March 2020. Grocery stocks fell sharply despite the fact that their sales were actually surging as consumers stocked up on essentials. These panics create windows to buy quality businesses at discounted prices. I also want to discuss portfolio rebalancing because it is an important aspect of managing grocery stock positions. Over time, different holdings will generate different returns. Some stocks will appreciate more than others. If you start with equal weights across 5 grocery stocks, after a few years, your portfolio might become concentrated in whichever stocks perform best. Periodic rebalancing, perhaps annually, returns the portfolio to your target allocations. This imposes a discipline of trimming winners and adding to laggards, which can improve risk-adjusted returns over time. It also ensures that you maintain diversification across the 5 companies rather than becoming overly concentrated in any single holding. Tax considerations matter for taxable accounts. The dividend income from grocery stocks is taxable in the year received, unless the stocks are held in tax-advantaged accounts like IRAs or 401k plans. For investors in high tax brackets, holding dividend-paying stocks in tax-advantaged accounts can be beneficial. Capital gains are taxed when shares are sold, so the long holding periods I advocate have tax advantages. Long-term capital gains rates are lower than short-term rates, and gains are deferred until shares are actually sold. The longer you hold, the more your investment compounds without tax drag. Let me discuss some specific metrics you can use to monitor your grocery stock holdings. For grocery retailers, comparable store sales growth is a key indicator of underlying business health. Comparable store sales measure revenue growth at stores open for at least 1 year, excluding the impact of new store openings or closures. Positive comparable store sales indicate that existing stores are attracting more customers or larger transactions. Negative comparable store sales might indicate competitive pressures or execution problems. Look for consistent, low single-digit positive comparable store sales growth as a sign of business health. Gross margin trends indicate pricing power and cost management. Grocery is a thin margin business, so even small changes in gross margin can significantly impact profitability. Rising gross margins might indicate successful private label penetration or favorable supplier negotiations. Declining gross margins might indicate competitive pricing pressure or rising input costs that cannot be passed through to consumers. Look for stable or gradually improving gross margins over time. Operating margin measures overall profitability and efficiency. Operating margins in grocery typically range from 2 to 5%, much lower than many other industries. Companies that can sustain or improve operating margins within this range are demonstrating operational discipline. Declining operating margins might indicate competitive pressures, rising labor costs, or inefficient operations. Look for stable operating margins that indicate the company is maintaining its competitive position. Free cash flow indicates the cash available for dividends, share repurchases, debt reduction, and growth investments after all operating expenses and capital expenditures are covered. Consistent positive free cash flow is essential for sustainable dividend payments. If a company's free cash flow is declining or turning negative, the dividend might be at risk. Look for free cash flow that comfortably covers the dividend payment with room to spare. Return on invested capital measures how effectively the company uses its capital to generate profits. Higher returns on capital indicate stronger competitive advantages. A company that earns 20% on invested capital is creating much more value than a company earning 10%. Look for returns on capital that exceed the company's cost of capital, indicating genuine value creation. Debt levels relative to cash flow indicate financial strength. Companies with too much debt are vulnerable during recessions when credit tightens. A common measure is debt to EBITDA, which compares total debt to earnings before interest, taxes, depreciation, and amortization. Grocery retailers typically have debt to EBITDA ratios between 1 and 3 times. Ratios above 3 times might indicate elevated financial risk. Look for conservative leverage that leaves room to weather economic downturns. The dividend payout ratio indicates what percentage of earnings is paid out as dividends versus retained for reinvestment.
Payout ratios above 70 or 80% might indicate limited room for dividend growth.
Payout ratios below 50% typically indicate room for continued dividend increases. Look for moderate payout ratios that balance current income with future growth potential. Let me also address what to do if one of these grocery stocks encounters company-specific problems. Not every investment works out as expected. Management might make poor decisions. Competitive dynamics might shift unexpectedly. A recession might hit a particular region harder than expected. If one of your grocery holdings underperforms or encounters problems, how should you respond? The first step is to diagnose whether the problem is temporary or permanent. Temporary problems might include a bad quarter due to weather, a one-time expense, or a short-term competitive challenge. Permanent problems might include a fundamental deterioration in competitive position, a loss of key management, or structural changes in the industry that disadvantage the company. Temporary problems are usually opportunities to buy more shares at lower prices. Permanent problems might warrant selling even at a loss. The second step is to assess whether the dividend's at risk. Dividend cuts are painful both financially and psychologically. They indicate management's lack of confidence in the business and often precede extended periods of underperformance. If free cash flow no longer covers the dividend, or if the balance sheet is deteriorating, a dividend cut might be coming. In such cases, selling before the cut might preserve capital. The third step is to compare the troubled holding to other opportunities. Capital allocated to a struggling company might generate better returns elsewhere. Even if you believe the struggling company will eventually recover, the opportunity cost of waiting might be high. Consider whether reallocating to a stronger company would better serve your long-term goals. That said, I generally counsel patience and long-term thinking. Most short-term problems resolve themselves over time. Management teams adapt to competitive challenges. Balance sheets recover from temporary stress. A stock that looks problematic today might be a star performer in 5 years. The risk of selling too soon and missing a recovery is just as real as the risk of holding too long through permanent decline. When in doubt, I tend to hold rather than sell, trusting in the fundamental resilience of the grocery business to carry the company through challenges. That is the kind of investment I want to own. That is the kind of investment that lets me sleep well at night, regardless of what headlines are screaming. And that is the kind of investment I encourage you to consider for your own portfolio. Buy quality, buy resilience, buy the essential businesses that people depend on regardless of economic conditions, and then hold for decades while the cash flows compound. It is not exciting, but it works.